Good morning, dear guests. Good morning, dear colleagues. Yesterday, we had a truly great first day of the conference, and I discussed that with several of you during dinner, and I think you all share this sentiment. So the depth of the discussions have set really a high standard for what promised to be an equally stimulating second day. So building on the momentum we have established, it is a great honor to open this morning's session with the introduction of our keynote speaker, John Williams. John doesn't really need an introduction, but I have to follow my institutional duties. So allow me, nevertheless, to briefly highlight some of the key milestones in his remarkable career. John is without question one of the most influential figures in the field of monetary economics, and his contribution have profoundly shaped both academic research and the practice of policy implementation. John currently serves as President and Chief Executive Officer of the Federal Reserve Bank of New York. In this role, he is Vice Chair and permanent voting member of the FOMC. He has been shaping monetary policy in the United States for a long time. After his PhD in Stanford, his career began as an economist at the Board of Governors, and he has since served in several prestigious roles, including senior economist at the White House Council of Economic Advisors and president and CEO of the Federal Reserve Bank of San Francisco. John's research has been published in the field's most prestigious academic journals, including Quarterly Journal of Economics, the AER, and the JME. And if I may, and I was mentioning that today morning to John, I would like to share with you a brief personal anecdote that underscores my personal appreciation for John's work. Many years ago in the early 20s, when I was in a graduate school and I found myself poring over one of John's seminal papers on measuring the natural rate of interest, what a surprise. So while the paper itself was a masterclass, I have to admit, in clarity and precision, my attempts to replicate its results were anything but. I spent many long nights grappling with the math and the code. We talked about the Kalman filter, fueled by determination and perhaps a little too much coffee. So standing here today is therefore a great privilege for me. Your work, John, has inspired many of us here, and your insights have helped illuminate some of the most pressing challenges that policymakers face today. The title of John's address is Theory and Practice of Monetary Policy Implementation, a topic of great significance as central banks navigate an increasingly complex and uncertain environment. Following his address, we will have time for a Q&A session, which I'm sure will provide an excellent opportunity to further engagement. John, thank you for taking your time to join us. The floor is yours.
Thank you, Roland, for that a very nice introduction. I have to admit, one of the things I learned early on was the advantages of transparency when you write papers, especially very technical papers, in posting your code. Because you were not the only one who was working on replicating results, but also asking us questions about footnotes and things like that. So posting the code and the data was, I think, helped a lot. Which is now, of course, standard practice in economics. So good morning, everyone. It's wonderful to be here with you in Frankfurt in our very interconnected global economy. I've been coming to events around the ECB from before the ECB existed and looking forward to being here today. It's important to have these opportunities like this to learn from the perspectives and experiences of others, whether we're academics, market participants, or practitioners of central banking. So the theme of my talk is the theory and practice of monetary policy implementation. Importantly, central banks differ in their objectives, strategies, and approaches to monetary policy implementation, all of which influence how they supply reserves, manage their balance sheets, and control short-term interest rates. But like Neapolitan and New York-style pizzas, central banks also share similarities. These were spotlighted in the ways they responded to the global financial crisis and then the onset of the COVID-19 pandemic. Then many central banks expanded their balance sheets through various quantitative easing programs funded in large part by increases in central bank reserves. And these experiences fundamentally changed the ways that many central banks approach the provision of reserves while maintaining control of short-term interest rates. As a result, central banks have reviewed and in some cases modified their strategies for supplying reserves and controlling interest rates in ways that reflect the unique features of their jurisdictions. Although the approaches differ in specifics, they share common elements that reflect the fundamental factors that shape the supply and demand for reserves. So today, I'll talk about monetary policy implementation frameworks that central banks use to manage the supply and demand for reserves, emphasizing the common features and mechanisms of these approaches. I'll also discuss in more detail the Federal Reserve's ample reserves framework. Before I go any further, I have to give the standard Fed disclaimer, and that is the views I express are mine alone and do not necessarily reflect those of the Federal Open Market Committee or anybody else in the Federal Reserve System. Monetary policy implementation frameworks are critically important to the conduct of monetary policy. They encapsulate the mechanisms and tools used to steer operational targets in line with the desired policy stance and provide liquidity to the financial sector. In supplying reserves to the banking system, central banks have multiple goals that frequently involve trade-offs. First and foremost, they target a level of the policy rate and aim to minimize the variability of the policy rate around that target. In addition, they have objectives related to supporting financial stability and the smooth functioning of financial markets. For example, central banks may see advantages or disadvantages to interbank lending in money markets, as well as costs and benefits related to central bank lending into markets. The core of any operational framework is the central bank's supply of reserves, which ranges from a low level, or scarce, to ample and abundant. The price of reserves is the spread between the market interest rate and the rate earned for holding reserves at the central bank. When reserves are scarce, the slope of the demand curve for reserves is steep, as I've illustrated here in Figure 1. A small change in the quantity of reserves results in a meaningful change in the spread. When reserves are ample, the slope of the demand curve flattens, but still slopes downward. So that small changes in the quantity of reserves have modest effects on the spread. And when reserves are abundant, on the right side of the figure, the demand curve is essentially flat. A central bank has basically two sets of tools it can use to supply reserves. And now these are illustrated in Figure 2. First, it chooses the ex-ante aggregate level of reserves to supply to the banking system. And that's labeled X on the figure. Second, it may make available a lending facility, broadly defined, to the banking system that offers loans to financial institutions at an interest rate determined by the central bank. And this is labeled by L in the figure. So if the ex-ante supply of reserves is sufficiently low, to the left side of this figure, the additional demand at rate L will be met by the lending facility. Note that both tools are a means to supply reserves. In the first, the supply is set in advance, while with the latter, it adjusts endogenously to market conditions. Now, central banks deploy various combinations of these tools depending on their institutional and market structures in their jurisdictions, as well as preferences over the trade-offs involved in their use. These choices represent, I would describe as different points among the set of options for using the two tools. So despite differences in the tactics, each of the approaches can achieve the goals of strong interest rate control and smooth market functioning. It's worth emphasizing that the two tools can be mutually reinforcing in achieving desired outcomes. For example, lending facilities limit upward movements in interest rates on days of high demand, thereby reducing the ex-ante supply of reserves needed to control short-term rates. The European Central Bank, the Bank of England, the Reserve Bank of Australia, they've all chosen to operate with a relatively small amount of ex-ante reserve supply and provide additional reserves as demanded at a rate near the policy rate. Counterparties can then draw upon as much or little as they choose based on their needs, subject to the ability to provide eligible collateral. In this way, even with a smaller ex-ante supply of reserves, tight interest rate control is maintained amid even significant movements in the demand for reserves. In the case of the Bank of England, the weekly short-term repo facility sees regular sizable use. In October of this year, it averaged around 85 billion pounds. Like that of other central banks, the Fed's operational framework has evolved over time, reflecting its experience with large balance sheets since the global financial crisis. In January 2019, when the decline in the Fed's asset holdings implied that the quantity of reserves would soon fall below an abundant level, the FOMC formally adopted an ample reserves strategy. The FOMC has defined this framework as one in which control over the level of the federal funds rate and other short-term rates is exercised primarily through the setting of the Federal Reserve's administered rates, and in which active management of the supply of reserves is not required. Accordingly, the ex-ante supply of reserves is chosen to be sufficiently large to meet the demand for reserves on most days. One important tool the FOMC has established to ensure interest rate control is the overnight reverse repo facility, the ONRP, which alongside with the interest paid on reserve balances helps set a floor for the federal funds rate. Through the ONRP, eligible counterparties lend to the Federal Reserve at the rate set by the FOMC, currently at the bottom of the target range for the federal funds rate. And the usage of the ONRP adjusts automatically to market conditions, rising and falling with supply and demand, which is particularly important in a dynamic market such as ours. The ONRP has proven to be a very effective and a flexible tool to support interest rate control to the downside. When Federal Reserve asset holdings push reserves above ample, the ONRP relaxes the tight relationship between balance sheet size and reserves and acts as a safety valve in supporting smooth transmission of monetary policy to markets. As the size of the balance sheet falls, market rates rise above the rate offered at the ONRP, and as a result, usage of the ONRP declines to lower levels. This dynamic is seen in Figure 3, which shows average monthly usage of the ONRP from 2016 through October of this year. And this figure, the 2,000, that's $2 trillion, as a ONRP had very significant usage. The ONRP was used extensively when it was economically sensible for the Fed's counterparties to do so. By contrast, it has seen very limited usage when repo rates are well above the ONRP rate, as is the case today. Back in 2021, the Federal Reserve introduced a standing repo facility of the SRF, which nicely complements the ONRP by providing interest rate control to the upside. The SRF rate is set at the top of the FOMC's target range for the federal funds rate, and this combination of an ample supply of reserves and an SRF rate at the top of the target range reduces the day-to-day reliance on the facility, except during periods of significant upward pressures on rates resulting from strong liquidity demand or market stress. By ensuring that adequate liquidity will be available in a wide variety of circumstances, the SRF plays a critical role in capping temporary upward pressure on rates and ensures markets of effective interest rate control and smooth market functioning. It's best thought of as a way of making sure that the overall market has adequate liquidity consistent with the FOMC's desired level of rates. In that regard, it differs from other lending facilities, such as the discount window, that aim to provide individual banks with liquidity when the need arises. The SRF has been effective as reserves have moved from abundant toward ample. Over the past 2 months, SRF usage has risen from essentially zero to having greater frequency and higher volume of take-up, especially on days of temporary repo market pressures, as seen in Figure 4. And in this figure, for those who can't see, the label of the axis goes up to $60 billion, and the chart goes back to July of 2024. And this includes the last a couple weeks through early this week. Like the ONRP facility, the SRF's effectiveness relies on market participants availing themselves of the SRF based on market conditions, free of worries about stigma or other impediments. And I fully expect that the SRF will continue to be actively used in this way and contain upward pressures on money market rates. At the outset of the pandemic, the Fed, along with other central banks around the world, responded quickly to restore market functioning, causing reserves to rise well above ample, as they did in many jurisdictions. In June of 2022, the Fed began the process of reducing the size of its balance sheet to transition toward an ample level of reserves. The FOMC said it intended to stop balance sheet runoff when it deemed that reserves were somewhat above ample, and then allow reserves to decline further as other liabilities, such as currency, grow. The process has worked according to plan. The Fed's securities holdings have shrunk from a peak of around $8.5 trillion in 2022 to $6.25 trillion today. At its meeting last week, the FOMC decided it would conclude the reduction of its aggregate security holdings on December 1st. This decision was based on a clear market-based signs that we had met the test of reserves being somewhat above ample. In particular, repo rates have increased relative to administered rates and have exhibited more volatility on certain days. Accordingly, we have been seeing more frequent use of the SRF. And the effective federal funds rate has increased somewhat relative to the interest on reserves after years of that spread being at a very stable level. Together, these developments were expected as the supply of reserves closed in on ample. Looking forward, the next step in our balance sheet strategy will be to assess when the level of reserves has reached ample. It will then be time to begin the process of gradual purchases of assets that will maintain an ample level of reserves as the Fed's other liabilities grow and underlying demand for reserves increases over time. Such reserve management purchases will represent the natural next stage of the implementation of the FOMC's ample reserve strategy and in no way represents a change in the underlying stance of monetary policy. Determining when we are at ample reserves is an inexact science. I am closely monitoring a variety of market indicators related to the Fed funds market, the repo market, and payments to help assess the state of reserve demand conditions. Based on recent sustained repo market pressures and other growing signs of reserves moving from abundant to ample, I expect that it will not be long before we reach ample reserves. The FOMC's implementation framework combines an ample supply of reserves with facilities to maintain strong interest rate control and flexibility regarding changes in the size of the balance sheet. This operational framework has proven to be highly effective, and it continues to work as designed. Now, other central banks use different approaches that operate equally well. We all face common goals and issues, and like the delicious delicacies particular to all of our individual countries, the similarities outweigh the differences. Thank you, and I look forward to our conversation. They tell us where to sit, Roland.
Good. Thank you, John, for an excellent and insightful speech. I must say I followed and appreciated all your arguments, though having lived in Italy for 4 years, I might take an issue with your claim that there are similarities between pizza napolitana and New York style pizzas.
You know, this was the riskiest thing I said in my speech. I have a lot of my friends and colleagues at the New York Fed have very strong views on Italian pizza. I took a chance, and obviously it's backfired already.
Okay, but on a more serious note, your framework that you described, and I think you talked about that also earlier in your May speech, and also you have research papers about the optimal supply of reserves, is really incredibly valuable, and it provides a clear and structured way to analyze the similarities between various operational frameworks. And of course, we also very much appreciate your statement about the way forward concerning balance sheet normalization process. So linking up with maybe the two parts of the speech, and you alluded to that, you described that after terminating quantitative tightening, or let's call it quantitative normalization, Isabel, right? We had a story yesterday with Isabel's speech who introduced a new terminology, quantitative normalization.
Well, okay, so I have to speak to that. My experience of the Federal Reserve is we've desperately tried to convince the world not to call things quantitative easing, quantitative tightening. We have large-scale asset purchases, normalization. It never works. The markets will come to their own decision, and they'll use whatever terminology, and then in the end, we end up taking it on.
So we know what we are talking about, okay? So the next step in the Fed's balance sheet management strategy, that's what you said, will be to assess when the level of reserves has reached ample, and this will be the time when the Fed will gradually begin the so-called reserve management purchases to maintain an ample level of reserves, as the other liabilities of the Fed will continue to grow, right? So at the same time, I think you showed it in your charts, we have observed more frequent use of the standing repo facility. So going forward, and we had a bit of discussion yesterday about the sequencing of the instruments. So going forward, based on your framework that you presented, how do you see the interaction between reserve management purchases and the use of the standing repo facility?
Yeah, and that's really a key question. I was trying to highlight that these tools are really both important, both the ex-ante supply of reserves as well as the SRF in this case, when we're thinking about the ample reserves working really well. And they are mutually complementary too. So you're absolutely right. So let me just say one thing I want to say slightly differently than the way you asked. I think when we think about reserve management purchases, it's not only to offset the decline in reserves that would happen through, say, the growth of our other liabilities like currency. It's also that we've learned through experience that the demand for reserves in the banking system grows with the size of the banking system, whether bank assets or other indicators. So we have to understand that this is a market where the demand for reserves is likely growing organically over time, but also can be growing in ways that are harder to predict in terms of changes in, say, regulation or changes in market structure. So it's not simply a mechanical kind of a response to that. But going back to your question, I think really it's about assessing, are we roughly in the ample reserves, kind of a space, and does this seem about where we want to be? And then having purchases adequate, the reserve management purchases adequate to both offset the declines that would happen in our reserves through the growth of currency and other liabilities, and also we think is consistent with kind of the underlying organic growth of the demand for reserves. So that's going to be an assessment based on, like I said, the market conditions. We're seeing all the indicators that that we've been following. We published this about a whole set of market indicators that we're looking at, and also outreach we do with market participants and understanding that. In terms of where this question of how often the SRF is used and what quantity, I think this is also a learning experience. What we know in the repo market is there are certain days, pretty predictable days, where we see upward pressure on repo rates, end of month, end of quarter, tax payment dates, Treasury settlement dates. We've also learned that the end of the Canadian year is an important date that we can add to that list. And so we understand that there's going to be those kind of days. And so on days like that, you would expect upward pressure and maybe enough upward pressure that there'd be some SRF usage. We've seen that over the last, not just over the last couple of weeks, but actually going back a few months. So I think that kind of usage would be the normal kind of usage you have on days that there's some upward pressure, or of course if there's some unanticipated kind of shock to the demand supply, to the market, that the SRF is always there. So I see it as really playing this important role. I think two important roles. One is on these days that have what I would describe as idiosyncratic or temporary factors driving upward pressure on rates, that it gets used, in modest to moderate levels. But it also ensures that for market participants, this is something we learned. I mean, we heard loud and clear that the SRF is there in the future. So I don't have to worry about what's my fund, for my funding needs at the end of next month or the end of this quarter. So I think it's going to be a balance. Zero usage of SRF was probably telling you're out in the abundant reserves. If SRF usage was happening in meaningful amounts on days where nothing else is going on, that would tell us that we probably don't have as ample reserves as we're looking for. But like I said, it's an inexact science. I do think that we are definitely on the repo market side seeing indications of moving from abundant to ample. Some of the other indicators haven't moved as much, but it's really about judgment. And I think that going forward, the issue is keeping, it's like a lot of things we do in policymaking, is trying to balance these objectives and do it in a I would say a predictable, consistent way.
Thank you very much. So just staying in the same framework, in one of your recent papers, you also discussed the concept of optimal reserve supply and the role of uncertainty and also shifts in the curve, right? I mean, you were discussing today more the movements along the demand curve, but there might be, due to financial innovation, change in preferences, there might be also shifts in the demand curve that creates a bit uncertainty about the path ahead. So how do you see, can you elaborate, how do you factor in the, in the assessment of the appropriate level of reserves?
Right, and I think this is a really important issue, and something that, yes, we did study, both empirically we see the evidence of shifts in the demand curve for reserves, but also, thinking about conceptually, and all policymaking is policymaking under uncertainty. So what your model tells you that if you had perfect information, what would you do, is a nice starting point, but you really have to layer on the various types of uncertainty. So I think when I think about this particular market, I think you can think of two types of uncertainty that we have to think about. One is relatively higher frequency or shorter term uncertainty. And the classic example for the Fed is the United States government has an account with the Fed, the TGA, Treasury General account, and that moves up and down for various reasons as the U.S. Treasury pays its bills and collects revenues. That's a perfectly normal thing, but that can move around. Well, when it is one of our liabilities, so when the TGA goes up, reserves go down, just this is arithmetic. And so that's kind of a shorter term kind of a factor that can move around in uncertain ways. And if you think about in our model framework, it tells you, well, either on those days where the TGA, let's see if I can do my math right, goes up and reserves go down, that either you're going to see more usage of, potential usage of the SRF because upward pressures on repo, or you hold a little bit more ex-ante reserves. I think the right answer is you have both of these tools and you try to balance using both of the tools. And that's what our paper really looks at in kind of a theoretical way. Then there's a longer term uncertainty. So let me give you this. If you look back at where reserve demand was in 2019, when we were kind of going through the similar kind of process, I mean, it was significantly lower than it is today. And I think the number of factors have shifted the curve outward. You can think of regulatory changes going back for, since the financial crisis. You can think of shifts in the business models of the banks and institutions who want to hold more reserves or see advantages of that. So I think we've seen, you could think of more structural shifts. And those are hard to predict and hard to know when they're happening and the magnitude of that. So I think you always have to be kind of cognizant and learning about how maybe more longer term structural shifts. I think that one of the big question marks for all of us is, this is not about today or next few months, but how will potential regulatory changes in U.S. banking affect the demand for reserves? How will the growth of stable coins or other digital assets, how could that potentially affect these demands? So I think that the point I'm making is not that I know the answer, but that we have to be aware that structural changes in these markets or market structure are going to have effects on the demand for reserves. And our ample reserves means we do, like we do with monetary policy, we have to move the policy instruments consistent with the structural changes of the economy. We have to make sure that what we're doing is consistent with achieving our goals.
Thank you. I think it's always good if economists are humble. Indeed.
Good and sometimes rare.
So now shifting the focus, and then I open the floor for questions, but shifting the focus from the size of the balance sheet to its composition. Isabel's speech yesterday underscored the challenges central banks face in determining the appropriate composition of the balance sheet. So what do you see as the key factors to consider when deciding on the optimal composition, particularly with regard to the duration of the assets held?
Yeah. So first, remember I gave you the disclaimer at the beginning? So I'll repeat the disclaimer. I'm going to give my own views and not necessarily this is the Federal Open Market Committee. Obviously, the FOMC has made pronouncements about kind of how we think about this in some ways, but others still these are topics that we're always thinking about and will continue to think about going forward. The one thing that's unique, or not unique, but is specific to the Federal Reserve's balance sheet, and I know this isn't the question you asked, but I want to make this point, is that we hold not only U.S. Treasury securities, but we hold agency securities too, agency debt, but much more importantly, agency mortgage-backed securities. And the FOMC has consistently made the point that as we've gotten out of QE, that we want to have our balance sheet primarily, or securities holdings, primarily in Treasury securities. So moving away from MBS over time. So that's just first thing, just to make sure I say that, because that is a very important part. I think in terms of the optimal composition of a central bank's balance sheet, I think I'll go back to some of the principles I laid out about monetary policy implementation. First of all, I think there are some general ideas or principles that apply to a lot of jurisdictions, but some things are very specific to different jurisdictions, different kind of trade-offs that people are facing. I think for the Federal Reserve, because of the policy actions we took in response to the financial crisis and then QE1, see, I guess I gave up on this QE, so what I'm going to say to you, QE1, QE2, QE3, QE infinity, and then the actions in response to the COVID-19 pandemic and everything after that. We have seen our balance sheet, our Treasury holdings, it has much longer maturity on average than the Treasury outstanding. And I think that from my perspective, that's a response, that's because of the policy actions we've been taking. Over the last several years, we've been buying across the curve. And I think having a somewhat neutral or close to neutral maturity structure in a central bank balance sheet relative to what's out there in the market, it seems to make sense. Now, can I argue, is this optimal? Can I make a case that you should choose to have overweight this or underweight this or that? I think that we're basically in the world of keeping it relatively simple, keeping it relatively neutral. Obviously, in the United States, the U.S. government makes the decisions on debt management, the issuance of debt, and all of that. So they're deciding for the public where do they want what's the maturity structure of the debt for the goals that they have. I view a neutral stance of the Fed over the long run as being one that is consistent and supportive of that goal of the long run. Of course, in the short run, you have to have that flexibility in your balance sheet to be able to take policy actions that are necessary. But again, a neutral kind of composition, I think, supports that. So that's kind of the principles I think about. We have to, obviously, there's a question of, we're pretty long right now, very long in duration right now. There's always a question of how do you get there? But I think that's how I think about relatively simple, kind of neutral or consistent with what the outstanding that the U.S. government is assigning.
Okay, thank you very much. So let's open the floor to the audience. Isabel?
So thank you very much, John, for a fantastic speech. I listened very carefully, and I believe I heard that you were actually quite open to banks using the SRF when they need it.
Yes.
So, if I'm not mistaken, that's a bit of a shift in tone, in the sense that there was a time when people said this is a backstop, which is really not supposed to be used, really only in very exceptional circumstances. So if there is this shift, I mean, it seems that actually your framework is moving a bit closer also in the direction of what we have in this more like demand-driven framework. And my question would be whether you would agree to that. Second, and relatedly, I mean...
that was your question, Isabel. Do you agree?
There's no leading.
So relatedly, I mean, of course, not every bank has access to the standing repo facility. Yeah. There's always a question, how does the redistribution of reserves work? And there may be friction, so maybe the small regional bank doesn't get access to the liquidity it needs. And then you also mentioned the discount window. So would you also say that for the discount window that it's less of a kind of backstop facility, and that also there banks should be should be encouraged to use it when they need it?
Well, okay, so there's a lot in that. When you said, are we moving closer to the ECB's approach, I actually think our approaches are just different points on the continuum, and I don't see them as far apart as sometimes maybe we talk about them, because we tend to talk about the technical parts. Conceptually, I think we're trying to achieve the similar things, and we're just different places on that continuum, and that's a point I made in the speech. I don't see this as a shift, so I want to be very clear on this. We did use the term backstop, and I have learned the hard way, and I really do not use sports metaphors in monetary policy. They always come back to haunt you. Backstop, at least in U.S. usage, has this sports kind of thing. If something that's behind you, it only catches the ball, if it goes past you. The way if you look at the FOMC's actual communication, which did use the backstop terminology, it's true. But what we said was to support interest rate control and to support smooth market functioning. And I completely agree with that. That has not changed. I think my view on the SRF is you think about periods where there's temporary increases or upward pressures on repo that is providing this cap or ceiling, or however you want to think about it, in terms of the upward pressure on repo. So should it be used, if it were used every day, would that be consistent with our framework? I would say no. If it's used on particular days because of particular circumstances, I think it meets this kind of test. Again, I think the term backstop maybe has and you used it yourself, as kind of this maybe unusual or something. This I view, and this is again, I'm expressing my view and the decisions we made at the FOMC. The SRF was never intended to be a crisis or a market, only a market stress thing. It was always meant to be interest rate control. If you go back to September 2019, which I kind of don't like to do, but I will, that wasn't a crisis. That wasn't a situation where financial markets were somehow in distress. It was a situation where there was, in fact, inadequate reserves in the system to have the interest rate control that we wanted. We didn't have the SRF at the time, so repo rates spiked significantly, and that did spill over into the Fed funds rate temporarily, and of course we mitigated that through repo operations then. So to my mind, this isn't about truly unusual or stressed or crisis situations. It's really primarily for interest rate control. I don't see that as a shift, but there's definitely an aspect of experience of that there are quite a number of days where you have these spikes, and I would say I'm not telling institutions what they should do. In my language in the speech, and I think the language we've been using is consistent. If it is there so that market participants, which is primary dealers and quite a few of the banks who operate in repo markets, that they're using this if it's economically advantageous or appropriate or sensible or convenient for them to do that. I do think of it, now you said this in the speech, and I think this is a subtle point. I see this as like when back in the day when we did repo operations to control the supply of reserves and interest rates. This is a way to provide market liquidity. It's not about an institution like the discount window who says, hey, I've got short-term funding needs, which could be for perfectly good reasons. I need this to kind of tide me over. This is really our way to make sure that there's liquidity. It's an endogenous supply of liquidity, and that is, I think, very similar to what's being done in other countries. So I don't see this as, again, a shift in this, but it's more of an application. In terms of the discount window, my view is the discount window has historically in the United States been stigmatized. That's very unfortunate because you want institutions using it when it's economically appropriate to do that. So I would love the discount window not to be stigmatized, and I really, it would be very unfortunate if the SRF were stigmatized. So to my mind, every institution should be using these facilities as appropriate.
Thank you. So, Jacques?
And I would not, however, go so far as call our system demand-driven. That was for...
At least not yet. Thanks, John, for your very interesting presentation. So I'm getting a sense that you're obviously getting more confident that you're getting close to ample reserves, and therefore a number of announcements you made. I'm curious to dig a little bit into your assessment. You mentioned market rates as a criteria for your assessment, and whether what has happened maybe happened somewhat faster than expected, or in fact, there may be other factors which are influencing the market rates at the moment, away from just the shift in regime. You mentioned TGA, obviously, given the shutdown and the lack of less spending from Treasury and the rise in TGA. We also had a very interesting presentation yesterday from Shria, from the board, showing that there may be elements of segmentations within the interbank market, which in Europe we know very well has had impacts, disproportionate impacts on market rates. And so could there be also situations where parts of the system are starved for liquidity, and therefore the better policy response may be to have more targeted solutions for those parts of the system, as opposed to pushing liquidity overall that may still not find its way to the overall, to those institutions that are most in demand for liquidity?
So the two of you have really taken the multi-part question to a new levels. See, and you shouldn't
this
blame
is Europe.
me. Yeah, you don't blame me if I don't remember all of it. On the first part of the repo market, so a couple comments on that. Yes, obviously a number of factors came together, especially in October and into early November. Some of it is the TGA having, the Treasury General account having increased somewhat more. Our interpretation is some of that, but it's not the biggest part, is the fact that government shutdown does mean less money going out and a little bit more cash on hand. But that is one of those stochastic factors that can happen. I know that right now that a lot of people are focused on TGA dynamics, and that's understandable. We also went through that with the debt ceiling issue, and those are important. But of course, I always take a step back and say, hey, there's uncertainty. A lot of different factors can change over time in the short run. TGA is just one of them, but other factors too. So our ample reserves has got to be able to operate effectively, even with whatever those shocks are, including things like movements in the TGA. So I think, and we had the whole bunch of things that are happening kind of at the same time around end of month and the Canadian year end and all that. So there's just a number of factors. They're all accumulating, mostly in the same direction. So I think again, those things happen. They're going to happen. They can happen at different times. So we have to be aware of that. In terms of, so that explains why we saw a bit of a move up, and then now, of course, rates have moved back down. SRF usage is down to zero or less. You can even see in my chart when it was up there. So there was temporary. I think this thing about, well, are we seeing it in the repo market but not seeing it elsewhere, and was it a little bit faster than expected? If you go back to 2018, go way back to 2018, in the first half of 2019, not late 2019, we were seeing some repo spikes at that time as well. So I think this is part of the, there's a transition period between abundant towards ample, kind of in that gray zone. Everyone talks about the kink, but you're going through that zone, and you start seeing the repo market having more volatility and upward pressure. We've clearly seen some upward pressure in the Fed funds level of the rate, not so much the volatility. So I think it's similar to what we saw before. What looks rapid is just because right now we just had some temporary spikes. What was the second part? Was yeah, so I think that is true. I think that has been true when you think about it. Getting back to Isabel's question, the SRF is basically it can cover pretty much anyone who's carrying out repo operations, who's eligible, has eligible collateral. So I think there's pretty broad sign up for that. So I think that covers that. Of course, we in the United States, I would say there's one huge difference between us and almost everybody, or maybe everybody, is we have this federal home loan bank system, which also can be effective at moving the redistribution, I guess was your question, Isabel, the distribution of liquidity across the system. And of course, for smaller banks too, they have the discount window. So I think we have ways that liquidity can be redistributed in the system. So your point is valid, but I think that in our system, it can happen through different dimensions, even if we're just providing liquidity at an aggregate level.
Thank you very much. Please.
Good morning. Thank you, John, for your really, really insightful speech. Eric Scotto-Dirina, the Rabobank. You did mention the importance to have a smooth market functioning and financial stability. And yesterday we did have some really good reviews of papers highlighting an increased role of hedge funds, for example. And therefore there is a noticeable change in microstructure. So I'm curious as to your views vis-à-vis the role of the Fed in this context and how it may change.
Yeah, that's another really great question and important question. And I think the facts speak for themselves. Unfortunately, was not here for that discussion, but I'm very aware of the role of this. And of course, the basis trade is something we talk about all the time. What happens in our capital, U.S. is a very capital markets intensive economy, financial system. That what is happening out there is something we have to understand and understand what we're doing, how it connects. So when you think about financial stability there, I think it goes back to, you think about interest rate control and also making sure that we have adequate liquidity in response to shocks. And so when I go back to the pre-2019 days, I remember there was a discussion among academics and others in the central banking community, is the repo market should be the market that everyone has complete confidence in. Like, well, the fact that hedge funds are funding through that's their decision and things like that. But fundamentally, the repo market is, of course, the U.S. Treasury repo market is something that we should have great confidence that it functions well, and of course the prices are occurring because of market forces, but it's functioning well. And so that's why I think in our monetary policy framework that we have with the ample reserves and with the SRF and the ONRP, all of those come together to provide very good interest rate control, but without us targeting a specific repo rate or trying to control it in a fine-tuning way, but allowing market forces to determine, supply and demand. Of course, as an economist, so it's only two words I know, but those affecting the repo rates, but making sure that kind of random or disruptive kind of movements in those markets don't create greater financial risks or vulnerabilities. So I think we're trying, again, I see it as kind of getting this middle ground. Markets are making market participants are making their decisions. We're providing, with our framework, stability in this key funding market, but the market forces are determining the rates. Of course, the Fed funds rates are our target.
Thank you.
We had a couple more.
Thank you. I'm Eliana Pietraro from Société Générale in Paris. I have a question regarding the standing repo facility. We know that the market is huge. The take-up was still very modest compared to the market. Do you think that this modest take-up has to do with the fact that not all banks have access to it, or because the excess reserve is still very, very huge and banks use that to fund their operations? And what is the amount that you would view as posing a problem? Sorry, I had to ask it.
So I think that a couple things. One is on some of the days in that chart, because usage has been in single digits or maybe double digits, 10, 12 billion of SRF, which is in the repo market, which is multiple trillions of dollars. This is tiny. However, what we've seen, if you look at the auctions, we run 2 SRF auctions a day. What we see is that market participants see the tri-party rate, because we operate in the tri-party segment. If that starts hitting or getting near or at or above the top of the range, which is, of course, the SRF rate, certain institutions will come in and they'll take advantage of that. Other institutions may say, it's a couple basis points, it's temporary. I've got other reasons. With my counterparties, I'll just keep those relationships going. So we're seeing economic forces and business decisions working exactly on the margin the way you'd expect. Now, we did see a couple days where tri-party, was more than just a couple basis points above. But again, we saw more usage, and we, again, financial market participants are making trade-offs. If you think the repo rate's only going to be above the range by a few basis points for a couple days, this isn't a huge financial decision. But we are seeing on the margin this usage. And I think on most days, what it is doing is stopping that tri-party rate from going any meaningfully above the standing repo facility rate. So I think the modest usage represents mostly that we're in this transition from abundant to ample. Is there an optimal level or right level? I don't know what that is. I think my answer to Isabel covered. It's probably more on the frequency.
Leo?
Thanks. Indeed. First of all, thanks a lot for this super good talk that you gave. I found it very, very clear. I'm Leo van Tadden here from the Monetary Policy Wing in the ECB. I have a very simple question. When I listen to what you said, from the perspective of the ECB, we are always, or I'm a little bit envious, because when you think about structuring outright a portfolio, buying, you can buy, at least until recently, US Treasury, which are perceived to be a super
Yeah.
safe, risk-free asset, anchoring the entire global system. And you indicated, in fact, a slight preference going down with agency debt, and if it all concentrate even more strongly in US Treasuries. In Europe, the situation is different. We don't have this. We face 20 sovereigns, so not all of them entirely risk-free. This is already a slight difference. So my question is, to keep it very simple, and going forward, what's going to happen in the US, I don't know. How important is for the implementation, all the things that you described so well, the fiscal framework that operates, so to speak, in the background? In particular, when it comes to the decision how to structure the composition of a central bank balance sheet.
Well, I agree with your points. I'm not going to comment. I'm glad you didn't ask me to comment about ECB policy, and I wouldn't have done it anyway. But you're right. Our job is simpler. We have a massive, incredibly liquid, incredibly deep U.S. Treasury market, so that's where we operate, mostly, and that's where we're focused. So that is a huge advantage. It's also a critically important market for the global economy, as we've seen. When the U.S. Treasury market is disrupted in any way, that spills over to all of our markets and global markets. In terms of how I think about this, I do, this is a subtle kind of answer, I think, but there's the U.S. government, the U.S. Treasury has clear authority on the issuance and management of the U.S. government debt. We are the central bank and independent and able to make our own decisions about how we want to manage our balance sheet and holdings. These are separate, kind of authorities and separate responsibilities. When I think about how the decisions made by the U.S. government and specifically the U.S. Treasury on this, they have their objectives, which very clearly articulated, and I think they follow very consistently over time. And from a monetary policy point of view, we are not in any way trying to interfere or somehow offset or anything like that. We're just doing what we need to do monetary policy. So when we do QE or something like that, we are expanding or extending the duration of our holdings for a monetary policy reason. When it gets to, if they make decisions about changing the maturity composition of the debt, obviously that would kind of play into my earlier statement that in the longer term, I would think that we should have a debt composition that our treasury holdings that is neutral relative to the outstanding over longer periods of time. But that's not like a short run thing. That's about what does kind of the steady state look like in the composition. So I view these as two different kind of jobs that they have and we have, but they're the ones really making the decision about the debt outstanding and what the composition of that. We're just holders we're just one of the holders of that debt.
Let's take one more question.
Okay.
Yeah, thank you for this very interesting conversation. Christoph Rieger from Commerzbank. Now, the origin of the latest tensions, I think, have clearly been in the repo markets, and I think we're seeing similar things in the UK. I would even argue in Europe to some extent, at least until this summer. Now, wouldn't you say that, given that there's more collateral still to come that the market needs to digest, and a lot of it doesn't end up with real money but needs to be funded in the repo market, so that this issue, I think, will grow bigger, and then that the SRF should really be the instrument of choice to really address this and could potentially also grow structurally over time as the balance sheet normalizes from the Fed?
Well, I agree with the premise that obviously the amount of U.S. government debt is growing, not shrinking, and is likely to continue to do that. The markets need to finance that debt will continue to grow. And I don't know if anyone showed the picture of the size of the repo market in the United States. It has grown dramatically over past recent decades or recent decade. So I think those facts are all right. I think the question of going back to, we have this decision, we have this ex-ante supply of reserves, which is really getting back to the amount of securities we hold on the asset side of our balance sheet, versus this issue of how much the SRF plays the role. I think that I'm an economist, so I have to use this term. The right answer is an interior solution. It's going to be a combination of both. It's not going to be the SRF is never used, but it's in our ample reserves framework. It's not that the SRF is the marginal supplier of liquidity on a regular basis. And I know Vicky's here, there you are. But I mean, I think the Bank of England represents a very clean example of being in the market on a regular basis, which works really well. So that's not our framework, and we're a little bit different from that in terms of where we are in this continuum. So you said the SRF will play a really important role. I agree, but I don't see it as the important role in the sense of we're going to have increased amounts of our provision of reserves through the SRF. I think we got to get this value X in my chart right, that we have enough ample reserves. So the SRF is really playing this role of being the endogenous, but if you will, I said safety valve, I guess in my remarks, it's the flexible part that can adjust to market conditions of a more temporary nature, not a more structural or permanent nature.
So John, this has been really great. So let me conclude this session with only one sentence. What a great start of the day. Thank you very much.
Thank you, Roland. That's great.